Good morning, everyone. Investing can be a powerful way to grow wealth, but it also comes with risks. Even seasoned investors make mistakes, and sometimes these errors can be costly. By learning from past blunders, both our own and those of others, we can avoid repeating them in the future. In today's talk, we explore some common investment mistakes and how understanding them can help improve our financial decision-making. Some people collect rare items like cars or antiques. I, however, collect mistakes, both my own and those made by others. It's not always easy to look back at errors, but doing so gives us insight into how our minds work. If we better understand how we think, we may find it easier to avoid making the same costly errors, especially when it comes to investment. Here are 4 common investment mistakes you should try to avoid. 1. Holding on to a bad investment in hopes of breaking even. One of my personal mistakes was holding on to shares of Pearson, a global education company, for too long. I bought the shares thinking education was a universal need and that Pearson was uniquely positioned to benefit. Unfortunately, I was wrong. I didn't want to sell at a loss because it would feel like admitting defeat. In hindsight, I should have sold the shares earlier rather than holding on to the hope of breaking even. The lesson is, don't let ego drive your decisions. Evaluate investment without emotional attachment. And if a stock isn't performing well, consider moving on rather than waiting for it to recover. 2. Focusing on nominal gains, not real gains. It's easy to tell yourself that a small loss is not that bad when dividends seem to make up for it. But in reality, I was still down 40% after accounting for inflation. The key point of investing is to grow wealth so that you can spend it in the future. Inflation can eat away at your returns, so it's important to measure your investment in real, inflation-adjusted terms. The lesson is, always account for inflation when calculating your returns. It's not enough to make money on paper. You need to ensure your purchasing power is growing. 3. Buying high, selling low. Most private investors tend to buy into the market when prices are high, drawn in by the success of booming sector, and sell when prices are low, panicking after a downturn. This behavior can result in significant losses. I've fallen into this trap too, following trends instead of making rational decisions. The lesson is, timing the market is difficult, even for experienced investors. Rather than trying to predict highs and lows, focus on long-term investment strategies. 4. Believing in stories over facts. As humans, we love stories. They help us make sense of the world. However, relying on stories to guide investments can lead to poor decisions. Early in my career, I believed that the Japanese stock market wouldn't crash because the government wouldn't let it happen. I was wrong. The market crashed and stocks halved in value. This was a harsh reminder that narratives don't always align with reality. The lesson is, don't build investment decisions around hopeful stories or assumptions. Rely on facts, research, and critical thinking. In summary, we all make mistakes, but the key to becoming a better investor is learning from them. By recognizing common errors and adjusting your approach, you can make smart investment decisions and avoid costly blunders in the future. Thank you for listening.